Good evening. Thanks very much for joining us on Business 360. The big breaking story coming in from the Reserve Bank of India. It has tightened the risk weightage for consumer lending from 100% to 125%. Now, this essentially means that banks and NBFCs will have to set aside higher capital buffers against the loans that they sanction. Now, the decision comes after the RBI governor had flagged concerns on the high rate of growth of consumer loans on multiple occasions, asking lenders to remain cautious. Joining us now are colleagues Latha and Ritu to explain the moves to us and the implications for banks as well as for NBFCs. Latha, Ritu, many thanks for joining us. Ritu, let me start by asking you, take us through the new norms, what the RBI has essentially said and what is on the exempt list so far.
Well, there have been repeated warnings from RBI on the very high growth rate in consumer lending, especially unsecured lending. And now finally you have the RBI stepping in to tighten norms, put in place more buffers. They have increased the risk weights for consumer loans by 25 percentage points to 125% for both banks and NBFCs for all outstanding and new credit exposures for consumer lending. Housing, education, vehicle and gold-backed loans, these are excluded from the new higher risk weights. Now, this essentially means that banks will have to put aside more capital buffers when lending to the consumer segment. Similarly, the risk weight for credit card receivables has also been raised by 25 percentage points to 150% for banks and 125% for NBFCs. Even in the case of banks lending to NBFCs, RBI says in cases where the current risk weight as per external rating of NBFCs is below 100%, the risk weight will be raised by 25 percentage points. In addition to all of this, RBI has also asked banks and NBFCs to review their current policies and put in place board-approved limits for the exposure to the consumer loan segment. Especially, it has highlighted in the case of unsecured lending. It has also said that all top-up loans against movable assets which are inherently depreciating, like vehicle loans, will have to be treated as unsecured loans for credit appraisal, prudential limits and other such purposes. Now, this is going to hit the NBFCs because the loans they get from banks might get tougher to get. Banks and NBFCs will also have to keep more capital for the loans they give in the consumer segment. Now, while banks are well capitalized, we'll have to see if this poses a challenge for the growth of the business. Remember, credit growth in the unsecured segment has been an outlier. We've been seeing 23-30% kind of growth rates at various lenders compared to an average credit growth of 12 to 14% for the country because of the high rise in loans, small value ticket loans from the fintechs, which are as easy as a click of a button, and that has resulted in record high borrowings even on the credit card segment.
Well, Ritu, hang in there. Let me bring Latha into the conversation as well. Latha, will this surprise the market? Will this surprise banks and NBFCs? Because this is something that the governor has been cautioning about.
Yes, the governor has been cautioning about, but this is a giant step. I don't think the market is prepared for this level of increase in risk weights. There were some people who were expecting higher provisioning on standard loans. That's one way of, slowing down. But this is a much more strong way of slowing down the flow of credit to unsecured areas. Now, let me give you the hierarchy of people who are going to be hit most. My sense is the NBFCs are going to be hit most. One, they get their money from banks. They don't raise money on their own. They don't have savings account. They raise money from banks. That amount will get less because banks have to keep more capital and therefore banks will give less loans to NBFCs. So source of money for them gets impacted, and the loans they make to consumers which are not backed, unbacked, which are not vehicle loans or housing loans, those loans they have to set aside more capital in both ways. So end business also gets impacted, source of money also gets impacted. In my hierarchy, I think the Bajaj Finance, Tata Capital, Aditya Birla Capital, those were the guys who will be hit most. Housing finance will be exempt, and even vehicle financing. So Shriram Finance kind of guys don't get impacted so much. The next set will be the banks themselves because they will require more capital. Let me just take a minute to explain what do you mean by risk weight. Now, when you say 100% risk weight, capital adequacy for any loan, if a loan is 100 rupees, the 100% capital will mean 8%. 8% is the minimum capital that will have to be back any loan. If that is raised to 125, it means 10 rupees out of every 100 rupee will have to be capital. The remaining 90 rupees can be deposits. That's what this means. So for every loan, you have to put in 2 rupees more of capital. And capital is tough to get. So that's how the flow of loans to unsecured will slow down. Now, how will banks be impacted? Most banks have enough capital headroom, so they may not be immediately impacted. But here it is more a signaling device. RBI is telling them that I don't want you to lend more. So it will anyway slow down the amount of loans going to unsecured consumer credit. SBI has just about enough capital. So they may have to bring down their personal loans a little more. I have not checked with SBI. I'm just going by their latest results, where their capital, CET1 capital as it's called, is just about adequate. So if they have to keep more capital for even historical outstanding loans, they have to set aside more capital. That could make things a little tight for them. The third impact, as I see it, there could be a rise in bad loans in GNPA. Now, I'll tell you why. There is a small category of people, and Sybil pointed out to that, who are borrowing from Peter to pay Pan. They have loans from banks. To service that, they take a loan from one NBFC. To service that, they take a loan from a fintech. These guys will be impacted because fresh loans will be hard to come by. So in the quarters to come, you may see a rise in GNPAs, gross NPAs, in this category, consumer credit. And fourth, as I see it, I think the volume of derivatives in equity market could come down, because there would be people who would be taking loans from NBFCs to play this market. So that volume also can come down.
You know, Latha, privately, and I know that this is something we've been talking about, privately, many have been expressing concern about the possibility of a bubble in the unsecured loan market. Now, with this move, as you point out, you know, it's a fairly aggressive move on the part of the regulator. Does that add weight then to that possibility?
Oh, absolutely. I think the Reserve Bank proactively flagged this. And I remember even asking the Reserve Bank Deputy Governor, Mr. Swaminathan, in the monetary policy about whether they will go to the extent of taking action, or, you know, they're only saying this. The Deputy Governor explained that they have, you know, he gave those numbers which Ritu just told you, that whereas general credit is rising by 12 to 14% in all verticals, in unsecured loans and consumer credit, it is increasing between 23 to 30%. He gave those numbers on air. And he said at the moment it is only an advisory. But if the advice is not taken, we may have to resort to action. Those were approximately his words. And I think that what may have pushed them over the brink could be what Cholamandalam said in the conference call. In the conference call, Cholamandalam said that the category of new business loans, that part which has come from fintech, is showing NPA of 10%. They actually said that, which means that the fintechs are bringing them customers. These are largely personal loans. And maybe Reserve Bank saw this and as an additional data. Sybil also pointed out that loans under 50,000 rupees, you know, those accounts are showing a higher tendency of NPA. It's risen from 4.2 to 5.4% NPA, June over June. And they also pointed out that these guys have 4 or 5 loans each. So, you know, all these guys have been flagging off the problem. And I think the Reserve Bank just went ahead with the data and acted on it.
Well, Latha, hang in there. Here's the RBI governor, in fact, as Latha and Ritu were both pointing out, just speaking last month after monetary policy on the rise of unsecured credit. Here's what the governor had then said.
Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability.
Well, that's the RBI governor speaking after the monetary policy, and perhaps we will hear more from the governor on the 8th of December as the MPC delivers its next monetary policy. We're now joined by Karthik Srinivasan of ICRA. Karthik, many thanks for joining us. We're just trying to understand the implications and the impact of the measures announced by the RBI. Your first reaction?
I mean, really difficult to quantify the impact. It's too soon now. But clearly, as you just highlighted, the RBI has been voicing its concern on the fast growth on the unsecured consumer loans for some time now. And there was always an expectation that RBI would come up with some measures to sort of slow down the pace of growth happening in this sector. So today, RBI has come out with the regulation wherein it has decided to increase risk weights for consumer loans for banks and NBFCs. So we need to look at it from two perspectives. One, given that the risk weights have been increased, does it immediately impact the capital profile of banks and NBFCs? Possibly not, because almost all banks and NBFCs are sitting pretty on capital at this point in time. But does it impact future growth? Yes. The access to funds, the cost at which funds will be made available to NBFCs and consequently to the underlying borrowers is likely to go up as a consequence of this particular measure. RBI, surprisingly has also increased the risk weights for bank lending to highly rated NBFCs. One can look at it again in two ways, that some of these larger and well-rated NBFCs may now need to tap more from the bond market rather than rely on the bank line for increasing business and availing more funds. Another way in which one can look at the overall measure is while direct lending to consumer segment, while direct lending to NBFCs by banks could see a downward pressure, but possibly it opens up opportunities for secured lending, especially on the securitization, DA, co-lending kind of a business model. We need to see how that evolves. But clearly, a quick comment, it's something that one was fearing would come, and the RBI has come up with its measure to slow down the pace of growth on the consumer lending business for now.
So you do, Karthik, expect some hit on the business for banks and especially for NBFCs after these increased risk weights are imposed, and that is with immediate effect. But Karthik, just to highlight for us, most of the banks that we've been speaking to during their earnings calls have been highlighting that they don't really have a very large unsecured retail portfolio that isn't backed by, sort of salaried accounts and such, especially from the likes of large banks like SBI telling us they hardly have any exposure in the sub 50,000 rupee category, and the unsecured retail lending that they have is that of government employees where they have salaried accounts. So where is the concern really? Is it largely on the part of smaller NBFCs and fintechs? Because banks don't seem to be giving out that signal.
Well, I think we need to look at it. RBI is not getting into details as to, is a salaried personal loan safer or not. RBI is just concerned or making a comment in general perspective on consumer loans. Second, from a bank's point of view, bank is a much more diversified institution as compared to any NBFC. A bank lending to NBFCs is just about 10% of its overall portfolio. Bank lending to unsecured consumer lending will again be a fraction of that. So immediate basis, as I said, the impact on capital, given that most of the banks are sitting pretty, would not be a matter of concern. But yes, this definitely would lead banks to have a relook at their risk policies, framework, and business model related to incremental lending to these segments. So till the time they finalize and streamline on that process, there could be some slowdown on the incremental lending which happens to this sector.
Karthik, just broadly from the banks that you track closely, what are the ones that will see a higher impact? Because A, they may not have high enough capital buffers in place already, or two, they may have a disproportionately higher exposure when it comes to consumer lending.
I really don't have the data immediately, but it's fair to say that over the last couple of years, most of the banks have gravitated towards the retail lending kind of a segment. Corporate lending has not picked up. There is still a muted growth on the corporate lending. So a large part of the incremental credit in the system over the last 2 years has been towards the retail part only. We need some more time to look at more granular data to sort of comment on this.
Okay, Karthik, do you think that GNPAs may rise now? There will be a small category maybe of borrowers who are borrowing from NBFC to pay a bank, borrowing from another NBFC to pay one NBFC. Those who are over-levered. So do you think those will now default because lending gets less, the pipeline is less?
It's difficult to directly answer that. Will the NPS go up? We need to understand that lending is a cyclical business. We've had last year and a half of a relatively benign credit environment, not too much of slippages, and we also seen periods of aggressive growth over the last 2 years. So it's but natural to expect that, over the next 12, 18 months, we could see some rise in delinquencies. But what quantum it would go, I think that's a bit difficult to comment. We also need to factor in that, unlike, let's say, 5, 6, 7 years back, today, banks, NBFCs have far more quantum of data available with them to sort of do a more effective monitoring of their clients. But having said that, clearly when the lending to a particular segment slows down, history suggests that delinquencies do tend to go up, when that cycle starts. So from that point of view, we could definitely see some rise in delinquencies happening across the consumer loan segment for sure.
Right. Karthik, many thanks for joining us. Latha and Ritu, appreciate you joining us as well to take us through the moves that have been announced by the Reserve Bank of India, cautioning the financial sector as far as unsecured loans are concerned, bringing in moves to try and slow things down on that front. Clearly signs of overheating as far as unsecured loans are concerned. That is the view of the RBI. We are going to take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.